Is it always in your best interest to put down enough money to avoid private mortgage insurance? Because depending on the person that you're listening to and the advice that you are being given, a lot of times you're told you want to put down 20% so you avoid the private mortgage insurance because that is just an added fee that protects the bank. Now, the truth of the matter is that yes, private mortgage insurance on a conventional loan is insurance that you pay to protect the investor in the event that you don't make your payments, you default on the loan. They are insured with that. Now, is it always a bad thing to have private mortgage insurance? Well, I want to talk to you today about three reasons why it might be a smart idea in today's market to have a loan with private mortgage insurance, which you're going to have if you put less than 20% down on the loan, on the purchase price of the property that you're buying. And if you put less than 20% down, you're going to have private mortgage insurance. Why it might be helpful. Number one, PMI lets you buy now instead of waiting because you are able to buy with a lower down payment. It might be you might have enough money right now to be able to afford that down payment, get into a house now, and start gaining equity today, and not be in a situation where your house is 2 to 3% more expensive next year than it is this year while you're waiting to save up that 20%. Again, if a house is going up 3% a year, if you buy a $400,000 house, you save $12,000 versus waiting a year. Plus, the $12,000 in price appreciation becomes extra wealth you've created for yourself. So, number one, PMI allows you to buy now instead of waiting. Number two, private mortgage insurance frees up funds to be able to pay off higher interest rate debt. I talk with people pretty regularly that are selling a house and they're wanting to put all of that money down on their new house so they don't have private mortgage insurance. The example, though, that a lot of times I see is that people have non-mortgage debt, whether that's credit cards, whether that's auto loans or student loans. And many of those loans have very high interest rates, and that interest is not tax deductible. So if you pay off all your non-mortgage debt, you put less money down on your house, and you have private mortgage insurance. If you take the interest rate that you get and the private mortgage insurance rate that you have, you could still be substantially less than what you are paying on your interest rate on the car, student loans, and credit cards. And the best part is that interest is tax deductible. Now, I'm not a CPA, so I'd encourage you to talk with your CPA about the tax deductibility in your situation, but mortgage interest on your primary residence up to $750,000 is tax deductible. The third thing that you may want to consider when you're looking at buying a house now utilizing PMI is that maybe you take some of those funds that you were going to put down on the house that is going to appreciate 3 to 4% a year, and you invest those funds in other investments that are earning substantially more than that 3 to 4% a year appreciation for the house. And you're more diversified because you have some of your money liquid outside of the house that is able to not only give you a return, but if something happened, unfortunately, you would be able to tap into that money and be able to weather any storm that you're going to be facing. So PMI is not always a dirty word. It's not always the wrong choice because, like I said, there's three reasons why you might want to consider buying a house this year and utilizing private mortgage insurance to do it. Now, I will say everybody's situation is different, and I offer everyone a complimentary consultation where we talk about what's important to you and your best path to responsible and successful home ownership. I'd love to talk with you. And if there's anything that I can do to help you, just let me know. Hope you have a wonderful day.